today. And the topic that Ryan will be speaking on today is transfer pricing under the latest OECD guideline. What has changed? Why does it matter? So I have to, let me get to read Ryan's profile before he starts. So just a moment. Ryan Finley, I'm reading his profile. Ryan Finley is a contributing editor with Tax Note International. He was previously a legal reporter for Tax Notes Today International for more than 5 years and continues to write primarily on transfer pricing, the OECD-based erosion and profit shifting project, and related international tax issues. Before joining Tax Note, Ryan worked as a transfer pricing consultant for 6 years. He holds a JD from University of Illinois College of Law. You can follow Ryan on Twitter at Ryan M. Finley. Ryan, of course, you know that the people you'll be addressing today are the members of the Nigerian Bar Association or any member of the public who failed to join our session today. You'll be talking to our people, educating them on your chosen topic. And I have to remind our members that Ryan will be focused mainly on the transfer pricing with respect to the new OECD guidelines and looking at what has changed and what, you know. So he is not, Ryan is not expected to discuss transfer pricing regulations in Nigeria or what obtains here in Nigeria. So that's another huge area that we will arrange for someone or one of us here to talk about what we have here. But the point is that transfer pricing, the principle are almost the same thing. It's the same thing. And if you look at what we're doing in Nigeria, Nigeria actually borrows the OECD models. So we used to have transfer pricing regulations 2012 and now we have 2018, right? So Ryan, you have the floor.
Well, thank you. I appreciate the opportunity to address the Nigerian Bar Association. It's a great honor. As you said, I've been writing for Tax Notes International for the last few years as a contributing editor. And your caveat about this being specific to the OECD is an important one. It's not just Nigerian law, but the OECD guidelines in general kind of have this nebulous, soft law is the term in American legal parlance, that they're not binding law, and they really only have force to the extent that they are transposed by domestic law or are sort of incorporated into the treaty architecture. So that's an important caveat. Excuse me. But with that established, the OECD guidelines also, as noted, are very, very important, very influential, even among countries that are not members of the OECD and did not necessarily have a hand in penning the text of the guidelines. Nonetheless, they're considered very influential. I think it's fair to say that the United Nations Transfer Pricing Manual also follows the principles of the OECD guidelines quite closely. In a sense, they serve for people who are more familiar kind of with the treaty framework. They sort of function as an extended commentary under Article 9, which determines the essentially the allocation of profit among associated enterprises, which are members of the same sort of controlled consolidated group. And you know, just to set some basic background for anyone who's not familiar, really the overriding principle under the OECD guidelines and, you know, virtually every national transfer pricing regime based thereon is the arm's length principle. And the idea there is pretty simple, although
sorry, Ryan, if I may come in, just explain
Sure.
to our members what's transfer pricing. You know,
Certainly.
people hear transfer pricing. I'm sure not everybody knows what it is.
Certainly. And forgive me if that was an overly specific way of introducing it. But yes, that's very important. Transfer pricing. So in some ways, it's a misnomer, right? It sounds like it sounds transactional in nature, but really it's a system for determining when you have a multinational enterprise, specifically that comprises multiple legal entities operating in different countries. You need some framework to determine basically the taxing rights that the countries concerned have over that sort of common pot of profit, or in some cases loss. There are many ways to go about this in principle, but the way that the international sort of treaty framework follows, the way that the OECD guidelines follow, is essentially pretending that these members of the same group are unaffiliated enterprises transacting with each other at arm's length. And that's called the arm's length principle. And so the idea is that each jurisdiction has the right to tax the income that the entities operating in their jurisdiction would have earned had they been transacting with the rest of the enterprise at arm's length. Conceptually, that's simpler than it is in practice. The OECD guidelines lay out a series of, the document is hundreds of pages long, a series of methods for trying to, how you actually quantify what an arm's length price is. But the idea is that if you, sort of on the basis of microeconomic theory, that if you pretend that these enterprises are independent, dealing at arm's length, each jurisdiction should end up with the right to tax the amount that corresponds to the economic activity happening in their jurisdiction. Sometimes it works better than others, but that's the idea. So that basic principle, to tie back into the OECD guidelines, this has been the overriding principle in the OECD guidelines since the first edition was released in 1995. But, in the last, certainly since the 90s, it's been one of the most, sort of fast changing and certainly controversial fields in international tax, and certainly in the US and many other countries, one of the most controversial areas of tax in general. The 1995 guidelines established more or less the basic architecture of what we have now, but they were amended in 2010 really to provide more detail more than anything else. The most controversial, and I think it's important to establish some of this background, even if in some sense it's old news, because it's important to really frame more recent developments. There was general dissatisfaction in a lot of jurisdictions, for varying reasons. Different countries have different sort of revenue interests and different policy propensities. But there was a lot of dissatisfaction as to whether the arm's length principle was giving countries taxing rights essentially over the income that they should have the right to tax. This dispute has not been by any means resolved, but it's what it was the impetus for the G20 OECD BEPS project, or the Base Erosion and Profit Shifting Project, which was kicked off in 2012. So this basically, it prompted a total re-examination of the OECD guidelines, and whether the arm's length principle is really still suitable for serving the purpose that I explained, essentially as the profit allocation mechanism. And in the end, they retained the arm's length principle, but made some very consequential amendments. And I think that's really the focus of what I'd like to talk about here. One of the final BEPS reports released in 2015, the Actions 8 to 10 report, essentially was a revision to the first chapter, the sixth chapter, and the eighth chapter, and some other chapters as well, but those are the most important ones, to the OECD guidelines, which concern the basic analytical framework for understanding the transactions that are taking place within the group, but also importantly, how risk, the allocation of risk among commonly controlled enterprises ought to be understood and treated for transfer pricing purposes. And this is very important because I'm sorry. Oh, I'm
No,
sorry.
go
I
ahead.
had okay. The allocation of risk, in some sense, it may sound artificial to speak of the allocation of risk among members of the same control group, but this has a very significant effect on the returns that controlled entities, commonly controlled entities, can earn. For example, if you have intangible development, which drives an outsized share of the profit for very large multinationals, if you're able to, as a multinational enterprise, to allocate a significant amount of risk to a low tax jurisdiction, then you're able to claim that the corresponding returns or the payoff later down the road is properly taxed in that low tax jurisdiction. This was really perceived as one of the major weak points of the pre-BEPS project guidelines, that you could essentially have artificial contractual assignments of risk among commonly controlled enterprises. So again, these are contracts between members of the same group, right? So they're not contracts in the sense of two private arm's length individuals entering an agreement. These are sort of stipulated from the top, and they really only have tax effect. So the idea was to re-examine this, and the way the OECD guidelines came out on this was that in general, there should be deference on the part of tax administrations to the terms of these intercompany contracts. That unless they are lacking in economic substance in the sense that they do not reflect the reality of the transaction taking place, that they ought to be respected. But specifically regarding risk allocation, they inserted sort of a compromise anti-abuse mechanism, which was they were the principles for allocating risk among controlled enterprises based on control. So this is very important. The OECD guidelines said that for a contractual risk allocation to be respected, the entity that bears the risk contractually has to exercise control over risk. Now, it's a very nebulous concept, control, right? And the interpretive disputes concerning this term have been ongoing, since they were first proposed, really. But the idea was to target what were called derisively cash boxes, right? Entities that were overcapitalized entities that did nothing in the sense of research and development or other kinds of intangible development, that they simply received money from the parent and then invested it in R&D development or intangible development under the terms of a contract, and then tried to claim the corresponding rewards. So this control framework, the idea was that specifically in this context, control means the ability to make the key decisions as to whether to take on a risk and how to manage the risk on an ongoing basis. There were related amendments, specifically in the chapter on intangibles, that tried to basically kind of incorporate this concept and apply it in the specific context of intangibles. And that's where some of you who are more familiar with transfer pricing may be familiar with the term DEMPI, or development, enhancement, maintenance, protection, and exploitation of intangibles. It's sort of a wordful, but the acronym DEMPI has become part of standard transfer pricing parlance since these amendments were made. And the idea was that these development, enhancement, maintenance, protection, and exploitation functions need to be properly rewarded when you have an intangible transaction or some sort of intangible related arrangement among controlled enterprises. Sorry, did you say something? Okay, sorry. And that, specifically the functions related to control over these functions and control over the risks associated with them, ought to be a major factor in determining where the allocation of profit ought to go. Importantly, the idea, the the consequence of these changes together, the control over risk changes and the DEMPI changes, were that an entity that does nothing but fund intangible development. So think of, your classic kind of Cayman Islands subsidiary that all they're doing is participating in some sort of arrangement with a parent company to develop intangibles, and they're not really doing anything. That all that entity should be able to receive is a risk-free rate of return on its investment. This was very important, very controversial, but as we'll discuss, somewhat limited in scope. There are also broader changes to the guidelines in the 2015, as part of the 2015 BEPS project and in the Actions 8 to 10 report. A lot of them are fairly granular and have to do with the process for how to sort of understand the transactions that are taking place. The term, the phrase adopted was the accurate delineation of the transaction, another wordful, but that's the OECD term. And it focuses with a focus on the intercompany contract on really understanding the specifics of the transaction that took place and using that as the basis for selecting the appropriate transfer pricing method and pricing the transaction. This led to a series of follow-up guidance projects that were subsequently incorporated into the transfer pricing guidelines. Probably the most important of which is the revised profit split method guidance. So the profit split method is one of the methods. The transfer pricing methods specified in the OECD guidelines broadly fall under two categories. One is transactional methods, and the chief among which is the comparable uncontrolled price method. And the idea behind that method is that you look for transactional comparables to the transaction that took place, and you use them to price the transaction. This is fairly straightforward, and it works well when you have transfers of fairly standardized products, particularly commodities, where you can find a comparable transaction with modest differences between that transaction and the transaction that's going on between the members of the group. It gets more complicated and more problematic as the complexity of the transaction rises. So, for example, back to intangibles, if you have some sort of license of intangible property, especially just to use an example of, say, one of your major American tech companies. Obviously, a company like, and I'm not commenting on the specific tax arrangements of any one company, but just for illustration, a company like Apple, Google, certainly there's no comparable uncontrolled transaction out there. No one is licensing anything like Google's proprietary technology or Apple's proprietary technology to unrelated parties. If they had it, they would almost certainly try to exploit it themselves. So these transactional methods are problematic particularly when it comes to pricing complex, high profit, intangible related transactions. One of the methods devised to deal with situations like this is the profit split method. And the profit split method, very broadly, gives the parties to the transaction what's called a routine return. And that's meant to reflect basically whatever part of the arrangement can be reliably benchmarked through comparable data. And then it allocates whatever remaining residual profit is left, either based on, it can be based on transactional evidence, but more commonly based on the relative costs invested in intangible development by the parties. So to use a simple example, say you have an entity in a U.S. parent company, and you have its subsidiary in Nigeria, and the subsidiary, does a lot of important work in customizing the product, to meet local regulatory requirements, to appeal specifically to Nigerian consumers, things that go beyond kind of mere distribution and contribute to the value of the local brand, trademark, or even, add to the technology as it's exploited in Nigeria. In that case, what you would do under the profit split method is you would say, okay, here are the basic functions that the US parent and the Nigerian subsidiary perform. And whatever's left, we'll try to, come up with a measure. And this can be quite complicated in practice, but in principle, it's relatively simple. Try to quantify the relative investment of the parties in the intangibles that are being exploited there. So you would look at sort of capitalized R&D costs on the US side, and you would try to quantify whatever investments in tangible development that took place in Nigeria. And you come up with an allocation factor, a ratio, and the remaining residual profit will get allocated to the two jurisdictions on that basis. This method became a particular hot point of contention among countries, particularly among developing and developed countries. I think there was certainly a sense on the part of the United States, but to a lesser extent among some other higher income countries, that developing countries were too eager to apply the profit split method, and that they were doing it in large part to deal with the lack of local comparable data. And this is an issue that's, it's a persistent issue that you'll hear raised in by developing country tax administrations, that they don't have the local domestic comparable data necessary to price transactions. So falling back on something like a profit split method, which relies on internal financial data, in their view, is often necessary. Developed countries are often resistant to this, say that it's not appropriate in their view to allocate residual profit to a jurisdiction simply because you don't have great comparable data. This tension culminated in I would say a fairly compromise approach, but still, reflecting the dynamics at the OECD, still, I would think a more developed country friendly approach that allows the profit split method to be used only when you have unique and valuable contributions. That's a term of art that probably would take too much time to go into exact detail, but it means more or less what it sounds like. You have unique and valuable contributions by both parties to the transaction. You have the joint assumption of risk by the parties. And that goes back to the control framework that I was talking about before, where you have multiple parties who are exercising control over the same risks, or you have a level of operational integration that's so tight that there's no disentangling the contributions of the different parties. This is fairly restrictive, I think, relative to what a lot of jurisdictions would have preferred, but that was the approach that was enshrined in these in this updated guidance that was incorporated into the last version of the OECD guidelines. The other important post-BEPS revision to the guidelines that I'd like to raise is the guidance on hard-to-value intangibles. And this is fairly granular, but I think it's important to at least raise one of the issues with intangible development. And I think you can pick up that a lot of the issues, a lot of the weaknesses, a lot of the stress points specifically concern intangibles because of the ability for multinationals to shift the ownership of intangibles that have no inherent physical location across jurisdictions. One of the issues was that multinationals would come to tax administrations and say, hey, okay, maybe we allocated a ton of profit to this low tax jurisdiction because our intangible paid off, but we had no idea it was going to be so profitable. It was such a high risk thing. Tax administrations are often skeptical of these claims, say that, okay, yeah, you're overplaying the amount of risk. You had a better idea of the amount of profit you were going to make, and we should be able to use the ex post essentially success profitability of the intangible as the basis for figuring out what the transfer price should have been at the time of the transfer. This is controversial because it's in some sense at odds with the basic idea of the arm's length principle, which is, that you should treat these transactions as if they took place among parties dealing at arm's length. Rarely do people dealing at arm's length transact and come together and say, hey, that deal worked out a lot better for you. Let me hand over more money. That's, I think most people would agree, uncommon. And for that reason, this sort of ex post reassessment of profitability was, considered quite controversial. This optional approach to hard to value intangibles, or HTVIs, in the OECD guidelines gives tax administrations, under restrictive circumstances and subject to various caveats, the ability to use ex post profitability to revisit the ex ante transfer price for intangibles. So this basically takes us through 2018.
Yeah, it seems we've lost Ryan. I don't know if it is from my own end. Okay.
Oh, my back. Yeah, I'm sorry. I just
Okay.
got a message. My internet
Okay.
connection is unstable. Sorry.
Okay.
It seems like I'm starting to run out of time in any case, so I'll try to make this brief. But that takes us through 2018, and if you look at the publication history of the guidelines, the most recent consolidated editions were released in 2017 and 2022. So things can take effect for purposes of the OECD guidelines before they're incorporated in a new consolidated edition of the OECD transfer pricing guidelines, which can be confusing for some people. But the main thing that this 2022 update added to the additions I already described was the incorporation of a new chapter on financial transactions. I would say after intangible transactions, for some of the same reasons, financial transactions, by which I mean intragroup loans, guarantees of third-party debt, cost pooling arrangements, things like this. This was perceived as another major stress point of the arm's length principle, because companies that are members of the same group can lend money to one another without the overall sort of pre-tax income of the group being affected. And financial transactions, just like intangibles, can sort of be shifted by paper transactions, or at least that's how someone would characterize them, in a way that could lead to aggressive tax planning. So this led to the development of this new chapter on financial transactions. I think just to focus on the key points and the points that were the most subject of controversy during the negotiation process and during the I would say post-incorporation interpretive process, concern debt equity characterization and what's called implicit support. So debt equity characterization, I'm sure many of you are familiar with that issue as it arises under domestic law. It's by no means a unique transfer pricing issue, but the question was whether Article 9, the treaty article having to do with transfer pricing, and the transfer pricing guidelines that implement it allow you to sort of scrutinize whether some sort of financial arrangement characterized as a loan is really a loan that should give rise to deductible interest. The US in particular was very resistant to this idea and argued that no, transfer pricing has to do with pricing. In the case of an intragroup loan, it has to do with figuring out the interest rate. It doesn't have to do with whether something is really debt or equity. But this accurate delineation of the transaction process that I mentioned earlier could be read as an analytical process for distinguishing what's really a debt instrument from what's really an equity instrument. And on a basis of the recharacterization potentially of a debt instrument as equity, disallowing the corresponding interest on that basis. This issue was, and I think this is probably one of the clearest examples of an issue that countries simply could not resolve. And it says in the chapter, if you read the introductory paragraphs in chapter 10 of the OECD transfer pricing guidelines, you'll see that it basically says countries are free to either do this or not do it, to use our transfer pricing principles as the basis for debt equity characterization or not. And that was a pretty striking outcome, because usually countries can come to some compromise. Whether they, faithfully implement what they agreed to is another matter, but usually they can come to some agreement in terms of the text on the page. In this case, they couldn't. The other issue, which I think may have more practical significance, depending on the jurisdiction, has to do with implicit support. Now, implicit support deals with basically the idea. It's quite abstract in a sense, but it can have a very significant monetary consequences. Whether when you have a member of a controlled group of associated enterprises, whether a borrower that borrows from another member of the same group in another jurisdiction, whether that interest rate should reflect the whatever resources that entity has on a standalone basis based on its own balance sheet, its own cash reserves, or whether the interest rate should be determined taking into account the reality that the parent company and the group as a whole would support that entity in the event of a potential default. That may sound academic and abstract, but it can have a huge effect on the interest rate. If anyone's familiar with the Australian Chevron case, this is probably I would say globally the most noteworthy and high profile case concerning exactly this issue. And that's what happened. An Australian subsidiary basically was paying junk bond interest rates to a low taxed affiliate on the theory that Chevron Australia's resources on a standalone basis warranted a very high interest rate, and totally ignoring the reality that, of course, Chevron would never allow its Australian subsidiary to simply flop. This is another area where I think the OECD guidelines came out with a compromise, but they tended to favor this idea that implicit support should be taken into account. You will still see, including in U.S. transfer pricing litigation, taxpayers very much argue that the standalone basis, sometimes derisively called the orphan approach, is the more appropriate way of figuring out what the interest rate ought to be. But I think the prevailing view, certainly among tax administrations, and it doesn't seem like there's serious dispute among countries, as there often is on this issue, that you have to take into account the reality of implicit support to figure out what an arm's length interest rate ought to be in these transactions. That basically takes us through the major revisions that are reflected in the most recent consolidated edition, the 2022 version of the OECD guidelines. I'd also just briefly point out, for people who are familiar with the two-pillar OECD project to revise kind of the international tax landscape in many ways, but the way that's most relevant for our purposes is something called Amount B under Pillar 1, which attempts to find, if you'll recall my earlier comments about how comparable data can be scarce in developing countries and in some small, very high income countries as well. This presents a difficulty that could sort of push jurisdictions to make controversial choices as to the best transfer pricing method to apply. This Amount B idea would take in theory, some of the most basic distribution transactions and assign them a fixed reserve, a fixed return. I'm sorry, did I cut out again? Okay, sorry. Okay, well, I'm wrapping up here. The idea with Amount B,
you still have time. You have
Okay.
almost, yeah,
Okay. All right.
you have almost time, yeah.
Okay. So I'll slow down a bit then. So with this amount B idea is that there's a class of transactions, particularly what's referred to as baseline distribution, that are relatively simple, and we all kind of know what the returns ought to be. These are not things that either taxpayers or tax administrations should be wasting their time arguing about, that we should just have sort of a stipulated fixed return. Here's a distributor should earn, call it 3%, of its net sales, and we'll all be done with it. This was supposed to be the less controversial part of Pillar 1, but it's ended up, as one may have predicted, fairly controversial in its own right. The negotiations on that are ongoing, but the idea is that this will ultimately be incorporated into the OECD transfer pricing guidelines once an agreement can be reached. So we're all closely following that and looking forward to that and seeing what will come of that. Are there any questions on anything that I've raised? I know I've covered a lot of ground here.
Thank you, Ryan.
Sure.
You're really verified because we actually allocated 1 hour for you. However, I think you've done justice to the topic, examining transfer pricing and all the changes that have been made in the 2022 guideline of the OECD, and comparing that with what we've had in the past. The principle basically remains almost the same thing. Arm's length principles has always been there. And as you talked about the changes in transactions, issue of inter-loans and all that, and intangibles. So I've already told my people that Ryan is basically looking at what the 2022 guideline, the changes that have been made, and they touched the basics of transfer pricing. We talked about companies operating in a group. When you want to, go into either render services or you give loans and all that, allocation of risk. And he talked about when, some companies may try to allocate more risk or intangibles to low tax regions or countries to make sure that they kind of retain more of their incomes. So, and all these are the things causing base erosion and profit shifting, which OECD is against. And Ryan, of course, if you would, I don't know whether you talk on this exchange of information. We have exchange of information on request, an automatic exchange of information now that is available, which helps tax authorities of different countries to know what is happening. So if you are cutting, I don't know if you want to talk on that or we can just, yeah. You muted yourself. I think I can't hear you. Can you hear Ryan? What's going on? Chima, can you hear me?
Yeah, I can hear you.
Okay, I can't hear Ryan.
You guys can't hear me?
I can hear you. I think you
Oh.
need to mute.
Okay.
Okay. I'm sorry about that. I'm not sure what's happening.
Okay.
Yeah, I should probably keep my comments on that somewhat limited, because the OECD transfer pricing guidelines generally aren't the sort of the instrument or the mechanism for handling exchange of information. However, major exception to that would be country by country reporting, which is part of the documentation chapter. That is a, I mean, and that is, and I'm sure you're far more aware than even I am about, how significant that issue can be for developing countries. I think, issues regarding confidentiality and appropriate use of country by country reporting data have really, I think it's fair to say, kind of frustrated the idea of country by country reporting and the automatic exchange of country by country reports, which, for people who aren't familiar, country by country reporting is essentially it's a sort of simple layout of the allocation of, basic economic indicators of activity, employees, payroll, tangible assets, things like that. And then, side by side with the amount of income allocated to these different jurisdictions. And the idea is that, as a tax administration, you can't draw any firm conclusions from this. But if you see a ton of income allocated to a place where there's one employee, perhaps that warrants further scrutiny. To my knowledge, that this is still a controversial issue. There are a lot of developed countries that are refusing to engage in automatic country by country report exchange with developing countries because of concerns that developing countries, tax administrations are not using the data as it was supposed to be used and not keeping the taxpayer data confidential. I think that's a dispute that falls squarely within the ambit of the OECD guidelines, and it's really yet to be resolved. I think it's a frustration for many jurisdictions, and it'll be interesting to see what happens.
Thank you. Thank you, Ryan. Now, before going to the question, and I've had about 4 questions here, which I'm going to read out for Ryan to provide his own views on that. I want to announce to the members of the Bar Association that the company for which the company that Ryan works, that is Tax Analyst, the producer, that the authors of Tax Note International and other products, through Linda Friedman. It was through Linda that I contacted reach out to Ryan Finley. We've been working with Linda for a very long time. And Linda was able to help us have access to Tax Note International for all the Nigerian tax lecturers, those teaching in the university, so they can use it to teach our students and even our students who are interested in. But now, through Linda Friedman and Ryan, they've extended this to Nigerian tax lawyers. Anybody who is interested, I have been sent a hyperlink through which you can easily access tax notes for your international tax matters. We're going to share it. So whoever is interested, and in fact, it's a very costly for you to subscribe for the subscription. It's really, really costly. So I use this opportunity to thank Tax Analyst, Tax Notes, Linda Friedman, and Ryan Finley for this gesture. Thank you so much. So can I go to the question? Question number 1 here we have by Ishak Apalando. So it reads, it is clear TP regulations everywhere are to prevent national tax authorities from arbitrarily declaring related persons controlled transactions as artificial. But is there a risk that in the absence of comparable data, the previous unchallenged assessment of a tax authority during TP audits can transform into needed comparable data? And if so, what risk does it pose to the idea of arm's length? I don't know if you understand that. Or
Yeah.
Could I read it again?
So the question, and please feel free to correct me if I understand it correctly, is whether.
Let me read it. It
Sure.
is clear that TP regulations, transfer pricing regulations everywhere, are to prevent national tax authorities from arbitrarily declaring related persons in group control transactions as artificial.
Right.
But is there a risk that in the absence of comparable data, you've mentioned about developing countries not having comparable data in certain cases, like in issue of profit splitting and all that, the previous unchallenged assessment, like unchallenged assessment that was done before, they were not challenged, of a tax authority during transfer pricing audit, can transform into needed comparable data? And if so, what risk does it pose to the idea of arm's length? Yes, we know that, if I understand Ishak very well, we know that, for instance, in Nigeria, we may not have the comparable data So, but if there was a TP audit previously, and there are unchallenged assessments where we can gather some data, can we now use those as comparable data? And if so, what risk does it pose to the idea of arm's length transaction?
Right. I mean, that's a really fascinating question. And I think it raises all kinds of issues, both theoretical and in terms of tax administration. I would say that under the basic sort of canonical OECD guidelines principles, you would never be allowed to use the pricing of a controlled transaction, whether it be pricing that was agreed to during an audit or anything. You would never really be able to use that as a baseline for pricing, at least under transfer pricing principles, for pricing transactions later on. Now, maybe under various taxpayer reliance rights, or under principles of tax administration in a particular country, maybe taxpayers do have a right to rely on what was agreed to in an earlier audit. But I think it would be quite a threat to the integrity of the arm's length principle and the OECD guidelines if you were allowed to use any agreement that's not based on essentially the arm's length pricing of transactions, however defined and however determined, as a comparable. Now, I have no doubt that happens in practice all the time, but I don't think you'd ever find that to receive kind of official sanction from the OECD guidelines, and precisely because it would be such a threat to the arm's length principle, because companies and tax administrations may agree on something just to make the issue go away, just to move on and focus on things other than tax disputes. It has no sort of theoretical foundation under the arm's length principle.
Thank you very much. I think I support your position, because definitely the baseline, the foundation is arm's length principle. Right. So whatever you might have agreed in the past, whether challenged or not challenged, cannot satisfy that principle.
That's right.
So I think this answers Ishak's question. Then an anonymous attendee now asks, what propositions, pricing methods, data gathering are in the OECD model to solve the problem of dearth of comparable data? He asks, what propositions, that is pricing method, data gathering, are in the OECD model to solve the problem of that of comparable data? I think Rian has actually answered this previously anyway, but go ahead, Rian.
Yeah, I mean,
so he's asking, is there anything, a proposition or something within the model that will solve that problem of that of comparable data?
Right, and so we did touch on this to some extent. The lack of comparables is, rightly or wrongly, has been perceived as mostly a developing country issue and has not really received a ton of focus at the OECD level. Now, you see sort of guidance released through joint partnerships of the OECD and the World Bank and the UN that try to more specifically provide practical solutions for the lack of comparable data. And I think it'd be fair to just very broadly characterize them as ways to avoid using the profit split unless you absolutely have to. But this you're not going to find a lot on this squarely under the terms of OECD guidance. This has typically not been perceived as a as anywhere near as urgent a concern among developed countries as it is among developing jurisdictions.
Thank you, Rian, and yeah, that's a very nice one. Then Kichikama Omehia asked, is there any way to characterize or measure the level of implicit support with a group of companies? Is there any way to characterize or measure the level of implicit support within a group of companies? I think
Yeah.
it's very wide and bogus. But anyway, and that is all about what the transfer pricing is all about, right?
Yes.
And yeah, and the methods of what are the basic. For instance, arm's length principle is there to whenever you are dealing with anybody in the group and it feels like, oh, you are not dealing at arm's length. There's that suspicion. And how do we determine that? Using any of the transfer pricing methods. But Rian, you can go ahead and
Well, what you said is completely true. I think there is one way, and this may or may not be relevant in particular circumstances, but one way to measure implicit support would be to just see what the subsidiary can borrow, what interest rate they could borrow from a third-party lender. If a third-party lender will lend to you at a lower interest rate, then your standalone creditworthiness would, by itself justify the difference in the interest rate is the value of implicit support. Now, it's not always possible to make that comparison, but when it is, that provides a rough measure of the value of implicit support.
Thank you, Ryan. Babs, Anima Facial asks, his question is, transfer pricing seems a bit complex. In simple terms, what does transfer pricing means? Yeah.
Yeah, I really wish I could help you out on that.
Finley actually explained this, and that was the first question I asked him. So, Finley, Rian, you can repeat yourself. You can repeat yourself.
I mean, this is a question that comes up, and it's always a laugh trying to answer it. But yeah, I mean that it is unavoidably complex. But in the simplest terms, transfer pricing is an attempt to allocate the profit of a multinational group to the various jurisdictions in which it operates, based on the sort of hypothetical assumption that the various members of the group are unrelated parties dealing at arm's length, and that you can figure out the appropriate allocation of profit by pricing these transactions between these parties. And the arm's length, essentially the arm's length return for a service, the arm's length return for manufacturing a good, for developing an intangible, should bring the amount of taxable income into the jurisdiction where those activities take place. That's the idea. It's obviously it takes every jurisdiction or agency that's tried to provide more specific guidance needs about 500 pages to do so. So that's probably it's something that defies a simple formulation, unfortunately.
Thank you, Ryan.
Yeah, doctor, maybe we need to use our Nigerian voice to explain this. I mean, let's see whether if you're a tax practitioner, you might have seen that under the various tax legislation, there are provisions to prevent fictitious or artificial transactions, and those provisions in effect says that where parties have had transactions that are fictitious, the FRS has the right to strike down the transaction and to make necessary adjustment because such transaction could reduce the tax payable by the parties. We have such provisions in the Personal Income Tax Act. We have in the Companies Income Tax Act and some other legislation. Now, in 2012, FRA come up with a fair transfer pricing regulation. Now, what the regulation is trying to achieve is to ensure that transactions between related parties, transactions between, let's say, subsidiary and parent companies, are conducted in a manner that would have been conducted if those transactions were conducted between independent parties. That is, if related parties enter into transaction, the price paid or the consideration paid in such a scenario should be, consideration that will be paid if the parties are independent or are operating in the open market. Because when transactions are not adequately priced, is going to reduce tax payable to the FRS, especially in a cross-border transaction. Now, let's give a scenario. You have a party, a Nigerian subsidiary contracting with a parent company, say in Cayman Island or one of the tax haven. Now, you can structure that transaction in such a way that the revenue could be depleted, could be taken away from Nigerian jurisdiction by the way you have structured that transaction. So transfer pricing regulation is to ensure that you don't take away revenue from Nigerian jurisdiction to a foreign jurisdiction in the context of subsidy.
It's like we lost Steve. It's like we lost Steve. Steve, okay. Let me pick up from where
can you hear me?
Yeah, we can hear you now.
Okay, okay. Yeah, so or you don't pay costs or expenses to a Nigerian party in such a way that there will be no taxable income in Nigeria. So Nigerian transfer pricing regulation is to ensure that the pricing arrangement between a parent and a subsidiary or related companies, the pricing arrangement is in such a way that that they will be taxed for Nigerian taxable income in that. Just to use that in a nutshell. So in Nigerian transfer pricing regulation is now mandating related parties to declare their relationship, declare the relationship, and also to disclose the transactions that have taken place between the connected parties in a particular year, so that FRS can have the opportunity to review those transactions and to ensure that the tax payable in Nigeria is adequate. So when you look at the regulation, so that it applies to wide range of transactions between connected parties, sale, purchase, purchase of goods and services, lease of tangible and intangible assets, licenses, and so on and so on and so forth. So in essence, in Nigerian context, there are some certain requirements, or there are some certain obligations where there's a contract between connected parties. The first obligation is that you must declare that there's a connected party relationship. TPR requires that the connected party must declare their relationship with another connected party, and this declaration is a one-off declaration. And once you must make that declaration immediately after there's such a relationship, or after incorporation, if the incorporation of the company have given rise to such a relationship. Now, the second requirement is to disclose the transactions that have taken place. Now, they have been a related party, they have been a relationship. The second issue is, has a transaction taken place in that particular year between that related parties? If there have been transactions, let's say there's been a lending arrangement between a parent and the subsidiary, and interest payment has been made. At the end of the year, as you are filing your tax return, one of the companies that are filing their tax return, they must disclose to FRS the money paid, or the transaction that the money paid from one of the connected entity to the other. Another, in fact, the most crucial requirement is what I have just stated. When the parties are entering into the transaction, they must conduct that transaction at arm's length. What it means conducting it at arm's length is to conduct it in a manner that independent party will conduct such transaction if they are, when they are transacting with each other. So that is, in the nutshell, that is what the Nigerian transfer pricing regulation is all about. Now, for us lawyers, there's always a compliance obligation. Lawyers have to scrutinize, when lawyers are advising parties in such context, you have to scrutinize the transaction to ensure that some of the broader principle or the obligation that I've just mentioned have been complied with, because failure to comply with this requirement could lead to penalties. So in the nutshell, that is what transfer pricing is all about in the Nigerian context. And of course, Ryan was talking about the international angle. But as he stated, there's some of the principles that he mentioned, the OECD principle, could be applied, is applicable, here. Then there's a requirement under the regulation for the authority to look at some of the OECD principles to the extent that they are not in conflict with the regulation in order to determine whether they have been a compliance with the arm's length pricing obligation.
Anyway, thank you, Steve. But what I need to add to what Steve has said is that, yes, I do not think that OECD actually drives transfer pricing virtually in all the OECD countries and other developing countries. So our transfer pricing regulation we have in Nigeria actually mimics or follows the OECD regulation. And the transfer pricing regulation we had 2012, which I think the latest one is 2018. We have 2018 transfer pricing regulation, and Nigeria also have the country-by-country reporting standard country-by-country reporting regulation of the FIRS. That the regulation that FIRS also uses for the issues of course, gathering information. I'm sure that FIRS has also subscribed to the automatic exchange of information that will help in gathering information. Of course, Ryan mentioned here that most Western countries don't trust developing countries and management of information, issues of privacy and all that, which are very important. But as Steve rightly pointed out, Ryan has also pointed out, this is all about a group structure or multinational. There's a control. There is maybe a parent company could be somewhere controlling the subsidiary. There's always that relationship in that group. So the tax authorities are monitoring what they're doing. If you allow them without having a regulation, one thing is that, as Ryan pointed out, is that, sorry, this is Nigeria. They'll take light instantly, and the office has to put up the gen to start. So that's why sometimes you see my listing taking off. So, for instance, if within intra-group, A is the parent company, B is the subsidiary, and A is in a different country, you can give a loan to the company here, and then the interest rate is too high. When you jack up the interest rate, the purpose is once you have the interest rate is high, beyond what you could get in an arm's length transaction. So beyond what you can get in an arm's length transaction, what it means is that, of course, we generally know that debts, the issues, interest rates, these are deductibles. So by the time they deduct it from their profit, then you're reducing the amount of taxable income available for the country. So that's why they fight it. So but the main issue we have to take away here is that transfer pricing deals with company in a group. And the main foundation is that these companies, each time you are selling anything, either goods or services, let it meet the arm's length principle. So, and of course, Ryan has the OECD. I believe that Nigeria will update its current transfer pricing regulation of 2018, following some of the changes made by the OECD in 2022. We'll look at how it is, how it's going to go, and we have seen the difficulties and the problems of applying this here. Issues of not trusting our tax authorities in giving us information, so it's a problem. And Ryan also mentioned about the pillars 1 and 2, which is still it is still ongoing agreement over that and issues. So we'll have lectures on that on Monday. So for those interested, they can always log on. So let me go to the next question. Chima, I don't know whether you will help us on this one. I don't know if it relates to tax transfer pricing or doubt. The question is, how can we control multiple taxation in Nigeria? Chima, how do we do that? How can we control multiple taxation? Is a very important issue.
I think, well, maybe I think Nigeria can actually or attempt to control multiple taxation. I mean, through the joint tax board. I mean, there should be an avenue for the public to, notify joint tax board about multiple taxes, because you see multiple taxes mostly at the local level. At the state and at the federal level, I mean, it's relatively under control, but of course, there's still incident of multiple taxation. I mean, this is a function of several authorities working together to ensure that citizens, we can't tax ourselves to prosperity. That's one thing. So the more you are taxing people, the more they are also devising means to evade tax or even not to comply with taxes. So, but we have the joint tax board. The essence of the joint tax board is to harmonize taxes to reduce multiple taxation. So I think the joint tax board have to be more. They have to be more effective. I mean,
Yes,
it shouldn't just
Steve,
be.
maybe,
It shouldn't be. It shouldn't be a board for just the tax authority. We have to have representative from the public, you know, because the problem that we have is that you are if multiple taxation is favoring the state or the local government or the federation, of course they are not going to solve the problem. So they have to enlarge the board to ensure representative by the general public, maybe NGOs, and maybe people in the academia
Steve,
like you.
because of our time, you know, this is outside what we're discussing today. I think maybe the ICLE board would discuss on that and give it as a topic that will be taking some time later.
I think so too.
Yes. Another anonymous attendee again asked, he said, thank you very much for this question. I understand your point on data privacy for automatic reporting, for automatic reporting for developing nations. Do we have any African nation that are able to overcome this, or are they simply abiding by CRS, Common Reporting Standard? CRS stands for Common Reporting Standard. Well, I don't know whether Ryan will be in a position to answer this anyway. He said, do we have any African nation that are able to overcome this? Like in the exchange of information and all that, where the Western countries will now trust us in sending out information. For instance, Shell, Chevron, when they file their returns in their home country, whether the, for instance, IRS in US can send the reports, everything about Shell, Chevron to FIRS, Federal Inland Revenue Service in Nigeria here. So you actually mentioned the issue, the privacy issues, which is a concern to Western nations. So he wants to know whether there is any African nation that will overcome this. You know, that's what I understand, that maybe the West will be able to trust. I don't know if South Africa meets that, you know.
I have to apologize. I'm not familiar enough with the specifics, but I will point out I really can't comment on CRS, but
Okay.
there are specific provisions, and I'm sure a lot of them are similar, that govern country by country reporting exchange. And I think it's fair to say that the majority of developing countries have struggled to gain access to CBC reports, but I'm not in a position to say that you know, every single one has or hasn't. So apologize for that.
Okay. Yeah, as I said, Ryan is not in a better position to answer that. I think some of us in this country or in Africa will be in a better position. I remember there was a time OECD came to audit what FIRS was doing and their automatic exchange of information, how I think they have all the equipment and everything. So I went there as a stakeholder to address OECD on what to observe FIRS is doing. And even the report eventually came out. The report from OECD came out that, you know, FIRS has a lot of ways to go in strengthening their structure and everything. And of course, they didn't mention privacy issue, but I know it is a concern to them, you know. So I don't think that we have met it in this country. I'm not aware, even other people like on the exchange of information, OECD exchange of information, I think they have the first stage and the second stage. Most African countries haven't even gotten to the second stage on the automatic exchange of information. Some of them are still operating on the request on information level. So yeah, the next question is from an anonymous attendee again. I think the anonymous attendee must be the same person and very knowledgeable in tax area anyway. So he or she asks, how do you think developing nations can truly benefit from OECD's two-pillar solution to BEPS. There has been a lot of suspicion regarding the inherent restrictions, which seems to target to favor only developed jurisdictions. We have a lecture, a topic that will address this on Monday, but we can also hear from Ryan.
Well, that is obviously a very broad question. I would just say that many share those concerns that animate that question. I think there are, especially when it comes to the OECD and transfer pricing guidance, that the rules were substantially written by rich countries for and serve the interests of rich countries. That concern is nothing has happened recently, either in the two-pillar solution or the OECD guidelines really to, I think, fully satisfy those concerns. And I think that's probably a dispute and a problem that we'll see for a long time.
Thank you for being frank. At least you're going to serve the interests of the West.
Yeah, that's right.
Perhaps that's why Nigeria refused to accede to the agreement, the proposal they have. Okay, let me go to the next question. The next question, the same anonymous attendee. The United Nations has the practical manual on transfer pricing for developing countries 2021. And OECD has guidelines for transfer pricing. Because OECD has updated it onto 2022, right? Does it mean that OECD applies worldwide? Does it mean that that OECD applies worldwide? Why that of UN is specifically designed for developing countries? Which one would developing countries adopt between the UNO, United Nations, and that of OECD?
That's
but
really
I think Rian actually answered this question when he said that UN is actually following OECD in all principles, but you can go ahead and throw more light on that.
Yeah, so I think this question I think it reflects what I think is a more substantive divide between the OECD Model Tax Convention and the UN Model Tax Convention, where there really are important differences, and whether you follow one or the other, has very significant direct legal consequence. If you read the UN Transfer Pricing Manual in the introduction, you'll read something to the effect that it was not the task of the Transfer Pricing Subcommittee to kind of re-examine and reassess established transfer pricing principles, that they're basically trying to provide a more accessible and practical explanation and illustration of those transfer pricing principles for developing countries. So you're not going to see the kind of substantive division, at least up to this point. Things could change. There are lots of talk about, an expanded role for the UN in setting multilateral tax standards. But for now, the role of the UN Transfer Pricing Manual has largely been to provide a more practical reformulation of essentially the same transfer pricing principles. So it wouldn't really be fair to say you follow one or the other.
Thank you so much, Ryan. Okay, the next question is from Prince Yusuf. Good day. Please, what is the fate of a Nigerian law firm for chasing a real estate and fiduciary trust for a client from another country's law firm holding such property in fiduciary trusts for clients in view of I will say I don't think Ryan will answer this question. It's a little bit off, but you've heard the question, right? Is this something you can express on?
That's a pretty specific question. I probably should lay off of.
Okay. Abiodun Adeniko asks, does issue of TP arise among group companies in Nigeria that are not multinationals? Yes. Yeah, that's the answer. So he wants to know, Abiodun wants to know if does issue of TP arise among group companies in Nigeria that are not multinational corporations. So he or she wanted to know whether TP issues are restricted to only multinational corporations. So it doesn't have to be multinational corporations. Once it is a group structure, then it applies. Moses,
can I give you 2 examples?
Okay,
remember that in Nigeria we have we have more than one tax jurisdiction. The companies operating in the free trade zone, their tax issues are treated differently from that of this. So you can actually transfer transfer revenue to companies in the free trade zone. It's still within Nigeria. Technically, it can happen. And remember, and when you have 2 related companies in Nigeria, and one of them is enjoying some level of tax benefit or reliefs, maybe is exempted, it has some incentives, either some of the 5 years some tax relief. So you can actually move revenue to those companies through transfer pricing mechanism. Since of course you know that the income will not be taxed. So within Nigeria there are some there are still benefits of transferring price or transferring costs from one company to another. So the TPR actually is not restricted to multinational, but that's the focus actually, because that is where you see tax advisors planning to ensure that tax revenue are moved from one company to another. But within Nigeria, it's still possible. So because of that, transfer pricing regulation applies to both multinational related companies in Nigeria and those at the multinational level.
Perhaps the reason you gave, the example you gave, is the reason why the Finance Act, of course, it has always been in the law, even though companies in those free trade zone don't use to file their returns. So exactly. Even they don't pay, the Finance Act say you have to file. So let's see what they have. So by the time we look at it and see that some of the things were matters in the custom areas, not within the free zone, then you have to pay tax on that. So exactly. The TP will also apply. Yeah. Okay. The next question is okay. I think this has been answered. Ryan has answered that before. Is there any African nation on common reporting standard? It has to be South Africa. So we've answered this before. Common reporting standard, a lot of countries and even Nigeria has subscribed to it. But the question is whether in practice, whether we're being trusted enough by Western countries to send us those information and all that. Yeah. So on common reporting standard, there's no, I think Brian has answered that question before. Then the next one, anonymous attendee, it has been very expository lecture. Oh, thank you. I'm glad you enjoyed, appreciated Brian's lecture. So much thanks to organizers, MBA, SLE, and Ryan Finley. Could transfer pricing be applicable where the transaction is within a nation? I think the same thing we answered. I think the answer is yes. It's yes. It doesn't have to be cross-border. So you could have different companies that are related but different names. As long as they're in the same family and there's a control, whether within or outside the country, TP will apply. So you have anything to say? Steve or Ryan?
I would just add really quickly that this is an area where countries vary a lot. Obviously, you guys are better qualified to speak to Nigeria. Some countries do apply transfer pricing rules domestically. Some do not. The U.S. does. I think the key is whether the allocation among members of the group would affect your aggregate tax liability, right? So if you have entities that are taxed in different ways or at different rates, or one more favorably than the other, then the allocation of income across entities will matter. And I think you'll see a lot of jurisdictions will apply transfer pricing rules domestically whenever that discrepancy is possible.
Okay. I don't know whether Steve will answer this. It's more
No,
specific.
no,
Nigerian.
I think we have answered that question.
No, you answer. I'm talking about next question by Max Ikongbe.
Oh, okay.
I'm done with the other question. Max Ikongbe wrote, what impact, if any, does National Office of Technology Acquisition and Promotion, NOTAP, have on transfer pricing, say in the area of license fees paid to technology between parents and its local subsidiary? Would prior approved fee by NOTAP in the same context be used as evidence of arm's length? What do you have to say?
Yeah, I think so. I think the NOTAP pricing approved fees by NOTAP could be used as evidence of arm's length distance, because of course one NOTAP there is actually the rule of NOTAP to ensure that the appropriate licensing fees are paid in the circumstance. It could be used. I think there's actually a provision that gave that empowered FRS to look at such to practices with no other regulatory authorities to determine whether there is adequate pricing. Yeah, it could be used.
Yes, thank you, Stephanie Okeke. We have to round up because Ryan has a lot he needs to jump out, I'm sure. Thank you, Ryan, for the lecture. My question is whether transfer pricing principles apply to data companies transaction conducted between foreign parent corporation and its Nigerian subsidiary corporation. If so, what methodologies and criteria are employed to ascertain the evaluation of intangible expenses pertaining to data for the purpose of establishing the requisite tax liabilities of subsidiary company?
Yeah, I mean,
So,
I'm
yeah,
sorry.
go ahead.
Oh,
Go
yeah,
ahead.
it's really a great question. Yeah, I think the transfer pricing rules. Again, I'm not speaking specifically to Nigerian transfer pricing rules, but in general, absolutely, transfers of data, transfers of anything of value really would be subject to transfer pricing rules. In terms of valuing data transfers or intangibles more broadly, that can get very, very complicated. As I was saying before, comparable data is very rarely available to sort of directly price it using a transactional method. What you'll see a lot of times is the use of profit split methods. You would basically look at the combination of transactions, including the transfer of data, that are relevant to the business activity you're looking at. And you would assign routine returns to the parties based on the simple benchmarkable functions they perform, which would vary based on the circumstances. And you would assume that the residual profit is attributable to these hard to value things like data transfers, and allocate that based on your sort of relative contributions to intangible development. There are other complicated valuation methods too, ones that draw on financial accounting valuation, sort of discounted cash flow based valuation approaches. But the valuation methods for intangibles and something very specific like data transfers can get very, very complicated, and the right method is very context dependent.
Thank you. Thank you, Ryan. I know your time is up almost, and thank you for agreeing to be with us today. Moses Azege asks, TP does not apply amongst companies in Nigeria. Free trade zone is technically not, this is not a question. Okay, that's, we jumped at. Ishak Apalondo asks, are there any direct impact of transfer pricing regulation on corporate governance? Are there any direct impact of transfer pricing regulations on corporate governance? Steve, can you give a back?
Well, maybe not directly, but in a way, compliance with transfer pricing regulation could, can ensure effective corporate governance. Because of course, if you are, the essence of transfer pricing is to allocate pricing arrangement appropriately. If that is done efficiently, I mean, that will see further, it will further corporate governance, but it's not actually directly. The question says directly, and I don't think there's any direct relationship, but indirectly, because even though you may have parent subsidiary relationship, there could be other parties that could be affected by the way a pricing arrangement, on the allocation of pricing or allocation of profit among companies. So in a way, so if that is done appropriately, I mean, indirectly, it will affect, it can further corporate governance, but not directly.
Okay. Thank you. The last question. Action 14 of the OECD against BEPS. Action 14 of the OECD against BEPS is to ensure that tax disputes are resolved through a mutual dispute resolution procedure. Where TP dispute arises between multinationals of two countries that do not have MLI, multilateral treaty implementation, this, which country would assume jurisdiction and what mechanism should be adopted in case where there is no multilateral convention to implement tax treaty?
Well, I could just address that, whether it's, based on the multilateral instrument or any other bilateral tax treaty. If there is no treaty, you fall back to domestic law. And although, as we're saying, Nigeria and virtually every other country follows similar transfer pricing principles, in theory, obviously the interpretation and application can vary significantly. But if you don't have a treaty as a multinational enterprise to protect you from double taxation through mutual agreement procedures, then you really have to seek your remedies under domestic law, which, depending on the country, may or may not alleviate the double taxation.
Okay. The last question here. The last question we're going to take will be from Francis Oloruntoba. He asks, how can the trust issues with the Western economy, between Western economies and developing countries, be handled to take advantage of common reporting standards to lubricate the economies of the developing country going forward? I mean, he tries to find out, how do we resolve the trust issue between developing countries and developed countries, especially, yeah.
I mean, it's a fantastic question that I simply do not have the answer to. This gets into politics,
Especially as it relates to the automatic exchange of information. I think that's what he wants to ask.
Yeah, right.
Yes.
I mean, I guess what the OECD would say is, do what we say in terms of confidentiality protections and, fair use restrictions. A lot of developing countries would protest that, hey, we're doing everything we can, and you guys are being a little too, strict and distrustful about this. And I think there are merits to those concerns. What exactly will satisfy the OECD and specific jurisdictions to allow them to go forward? I mean, it probably varies by multilateral organization and jurisdiction. And like I said, it's a controversial, subjective, political, hot button issue that I don't think there's a clear answer to how to resolve those issues.
And I'll add, we'll have to fix our system too. We'll have to fix our system issues of corruption and all that, so that you don't have people selling information. So if we send you our data and information, you don't have to sell it. You don't have to misuse it. We need to be sure that you do what others do. So that's the question. Until we fix that, then if not, they will continue to have that distrust in our system. Thank you, Finley. I'm very grateful for you for attending this. You squeeze out your time because this was we chose a different date, but because of your conflicting time and all that, you still agreed to come and be with us. And I use this opportunity to thank Linda Friedman, who arranged this. And Linda has been very supportive of Nigerian tax practice and especially those in the university. The tax analysts produce a lot of tax literatures in international and American domestic. So Linda, as I said, the last time I contacted her, she was able to give us access. Nigerian law students or anybody in tax that is has anything to do with tax. She gave us access to Tax Note International and all that. So, and now they're just extending the same gesture to the members of the Bar Association. They have given me a link through which anybody who is interested to have access to Tax Note International be able to access that. We're going to share it later. Thank you, Ryan, and thank you, Friedman, and I also thank the entire tax analyst group in the United States and Tax Note for the support they're giving us in this country. We appreciate you guys. And we also encourage our people who are working in the big multinational corporations here, who some of their in-house counsel, I'm sure they can easily subscribe for your products. Thank you so much. And thank you, Stephen Chima, for being with us and all the members of the team. So we have to call it a day today. I don't think there's any lecture tomorrow. Do we have any lecture tomorrow, Steve?
No, we don't have tomorrow. We have on Friday. And
On Friday.
as we have indicated, which maybe you need to also announce that there may be a shift in time.
Have you, but you have to be sure that there's going to be, have
yes,
you talked to them?
Yes, he confirmed that he's starting by 2:30.
Okay, so tomorrow's lecture, Friday's lecture, right?
Friday, yes.
Friday
2:30.
lecture is starting by 2:30. We'll open up by 2:30. So, and there will be a flyer that will be circulated for that purpose. Thank you, everyone. Thank you, members of the bar. It's been a good day. And thank you, Ryan. Thank you, Linda Friedman. Thank you.
Thank you.
Thank you, Ryan. Thank you, Linda.
Thank you. Bye-bye.